Hi everyone, it's great to connect with you. I'm Laura Cornish, Senior Manager Communication Strategy for a well-known Investing in African Mining Indaba, and I'm here to bring a digital voice to some of the key topics and trends in the African mining industry. This week we are talking all things ESG, one of the key topics and themes taking place at our event this year. First up, I have a very experienced expert on the topic, Eric Lilford. Eric is a minerals and energy economist, a mining executive, and this is a mouthful, Curtin University's Associate Professor and Head of the Minerals and Energy Economics discipline for West Australian School of Mines, Minerals, Energy and Chemical Engineering faculty. This year, Eric is moderating an investor panel discussion at Mining Indaba titled Qualification and Quantification of ESG Risk and Uncertainty Across the Mining Lifecycle. So, preempting the topic and delving into a few key points around it, I caught up with Eric to get his insights. So, Eric, let's face it, ESG is not a new topic anymore, but interestingly, I think there's still a lot to be done. So where do you think we stand with regards to complying or meeting the principles of ESG?
Interesting one, because ESG is broken down into the regulated components, typically of environmental, social, governance. So we all know that. And companies are at that space or at that time where they comply with what's required from a legislative point of view. There's an issue, though, when we consider the non-regulated aspects of ESG, because companies tend to reflect that they've achieved their legal requirements and the rest is a nice to have. So you have this gap. So these unregulated aspects, they typically can only be met through extensive dialogue and interactions with stakeholders like communities, and they are likely to be affected by the ESG outcomes, or they affect the ESG outcomes over time. So, these stakeholders are predominantly your local communities, but they could be employees, NGOs, government bodies, activists, landowners, etc. And what makes the compliance somewhat challenging, there's three factors. Many companies have multiple assets. So each asset has a different community or set of stakeholders. So you have to address the ESG compliance associated with a specific asset way beyond the regulated component. The second part is that ESG actually comes at a cost. So if you are a marginal operation or a marginal company, the chances are you will perform to the legislative requirements of ESG and probably overlook the sort of nice to have components of ESG, and that could be extremely detrimental to your operation. The third one is that actually ESG, because it's relatively new, we are lacking specialists and skills associated with ESG. So you're dealing with a small pool of skilled people who can actually deliver the overall complete ESG outcome.
Thanks, Eric. I think some pertinent issues raised there already. I'm thinking a little bit about what you're going to be talking about at Mining Indaba, and I think this lends itself very well to my next question, which is sort of having you identify the top 5 greatest risks or liabilities when it actually comes to ESG.
Again, I guess that'll depend on company to company, asset to asset. And if I had to look at it, I think the S part of ESG is probably the greatest risk. So let's just look at what I think might be the 5 greatest ones. The first one is on a social aspect, the S part of the ESG. Engaging meaningfully with potential affected parties to ensure that future likely outcomes are understood, addressed, and mitigated if necessary. That's first and foremost. The second one is also from a social slant. Inadequate accommodation of the wider community. If you only liaise with the high echelons of the community hierarchy, then call it the subordinates of that committee representing the community are not necessarily involved in the ESG outcomes or what's required or wanted or needed as far as the community is concerned, and you miss the point, in which case that hierarchy is actually doing a disservice to the community. So that's a risk as well. Of course, the ENG, the environmental governance, has a nice role to play. So this is the third point. Climate change, which is a consequence of inadequate ESG outcomes. Climate change is an extreme one. We introduce things like carbon trading, we put a price on carbon, but the problem is we don't have a universal price on carbon or carbon trading. So what happens is one country might have carbon trading, in which case that adds a cost to certain environments. And this is, as I said, just the ENG component of ESG. And therefore, what that does, it drives business away because carbon trading is a cost to the company unless you can clean up your act and reduce carbon, etc. So what then happens is you chase away business to a jurisdiction in which you do not have the same requirements, and ultimately you go for a lower cost environment. So that's a key component which we can throw on top of that political risk and conflict, and that kind of thing goes in with what I'm talking about on carbon trading. The fourth one I have to come back to social, and it's things like activism or mobilization of stakeholders preventing further development of an asset or continued operations of an existing asset. So that's a very real problem. The final one, I think, is a sort of that elephant in the room, and I'm going to call it the big one, because companies securing debt and or equity are more and more exposed to the world's view and investors' views and capital being associated with something that is detrimental to an ESG outcome or does not comply with ESG requirements, or from an ethical point of view, do not have that ESG built in. So you're finding that companies who are looking at recapitalizing or developing a new asset or expansions, unless they've got a strong balance sheet themselves, we're finding that ESG is getting more and more, has more and more to say about whether that company can succeed in securing debt and or equity.
Interesting, Eric. And I think what really stood out for me was the fact that you said, ESG is not, that it is new. And so while the principles that you're raising are not, the topic and how companies execute it and how they deliver on it and how they communicate on it is what has come to the fore. So thanks again, Eric, for raising that. And I want to jump back to the S that you've highlighted as being so important. What basic advice, because this is a very heavy question, so just simplistically put, would you give to miners when it comes to that S, social elements of ESG?
Yeah, that is the elephant in the room. So from a company or asset point of view, you have to recognize the negative impact that zero and adequate ESG proaction will give rise to. That's categoric. You have to engage with communities, other stakeholders early on, openly and frequently. And those are the critical parts. Early on, openly and frequently, there has to be continuous dialogue. And it's not just dialogue for the sake of dialogue. It has to be engaging. So absolutely critical, keeping in mind that, ESG is not just about the legal compliance. So it goes way beyond. We were talking about the S part being, or the ESG being new. When we talk about an SLO, social license to operate, that's not new. And yet an SLO is spoken about less frequently nowadays because the SLO is built into the S part of ESG. So social license to operate is not part of this ESG. So yes, we've been dealing with SLOs for many, many years. ESG in and of itself as a collective is fairly new, but the individual components are certainly not new at all. The other thing is, if you look at ESG and you act on it, your outcomes will vary over time, and they actually could provide you with a positive outcome. So everyone looks at ESG as this negative thing, as an overhang, as a cost, and boy, all it's going to do is going to drain us of time, money, effort, input, take away focus, etc. And it doesn't have to be. If you're proactive about it, you engage early, you can actually have a positive outcome. We talk about ESG investments. We invest in ESG. What does that mean? Well, in my mind, being an economist or minerals economist, if you invest in something, there's always going to be a return. So what is an ESG return? And no one can answer that question yet. I mean, I've got a good few ideas, and come to the Indaba and listen to the session, and I'll hopefully address some of what's in my mind as to what an ESG return looks like when you consider that we have to invest in ESG.
Excellent, Eric. And since you just touched on what you'll be speaking about, is there anything further around your particular session that we can whet our audience's appetite with? What can they expect further?
Okay, yes. Now, in the world of ESG, and it's actually from, it's more than just ESG, we look at 4 key paradigms. And I took these ideas from Donald Rumsfeld back in 2002 during one of the wars. And they are the known knowns, the known unknowns, the unknown knowns, and the unknown unknowns. Now, that sounds, gee, who's going to listen to all of this? But what I want to do is clarify in the audience's mind what we're referring to. When we talk about something that's tangible, You can taste it, feel it, smell it, see it, sense it, etc. So we have a tangible something. So what is that tangibility? A tangible risk. Well, what's a risk? Risk is something that is known and we can often mitigate against. You can sure against a risk. So you have a tangible risk. That's a known. You have a tangible uncertainty, but the uncertainty is different to a risk. It's an uncertain outcome. That is then a tangible uncertainty, then is a known unknown. You have an intangible risk. Again, the risk part is known. The intangible is unknown. So that's the unknown known. And the final one, which is the difficult one, is an intangible uncertainty, notably with ESG, which means it's an unknown unknown. We can qualify a lot of these known knowns, known unknowns, unknown knowns, and to some extent the unknown unknowns. But quantifying is where the challenge lies, because as I said, you can have investment in ESG, meaning that you should likely generate a return. How do you quantify the return of an intangible uncertainty? Or even how do you quantify the unrealized liability associated with an unknown unknown or intangible uncertainty? So hopefully my intention is to go into some of this, but from more of an explanatory point of view, and hopefully it generates some food for thought, and we can get some ideas of where the gaps are in getting to quantify these, not the terms, but the actual outcomes associated with known knowns, known unknowns, unknown knowns, and unknown unknowns.
I think that's great, Eric, because we've got this topic. It's really broad, it's really on point, and what you're going to do is unpack it in an area that's really, really relevant. So I anticipate a full house for your session. But let me end, Eric, with a pretty obvious question, but I think it's pretty good to chat to you about this, or to ask you, why deliver this topic to the Mining Indaba audience? Why Mining Indaba?
Listen, the Mining Indaba has been one of my more frequented conferences over the last, I don't know how many decades, and I know I've been to in excess of 10. So that, I suppose, there's familiarity. It's also one of the world's preeminent conferences for the mining industry. It's global. Yes, there's a lot of African representation, which of course are the emerging markets, but it's got global representation. So that's the second thing. It's got excellent reach. The third thing, just by virtue of its title, Mining Indaba, it's resources focused. And even though I look at energy as well as natural resources or minerals, this is an ideal arena in which to put forward some of the thoughts that go into where the world is going as far as natural resources are concerned. And I suppose the final reason is, oh, come on, it's Cape Town.
What a great way to end. Eric, thanks for your time. Thanks for giving us a few teasers around what you're going to be chatting about at Mining Indaba and what people can expect from your session. I think it's really going to be an excellent one, and I look forward to catching up with you there. Thanks again, Eric.
Thanks very much, Laura, and thanks for the invitation. Appreciate it.